everybody doing today? Good to have you here first thing in the morning, and we're going to go through. I got an exciting class for us today. The first thing we're going to do is we're going to go out and we're going to play with bubbles a little bit, and we're going to see if there's not any markets that we can day trade. All right. Now, I know it said out on the little marquee we're going to do rebalancing of our portfolio, and we're going to do that too, but it doesn't take a whole class. So we're going to do that towards the end. We're going to go about halfway through the class, do a little day trading today with the markets, and then we're going to rebalance our portfolio, and we're going to talk about taxes. All right, tax loss harvesting. So much fun. Everybody wants to tax loss harvest. So that's what we're going to do today. And if you're excited about that kind of thing, then this is your place. If not, go somewhere else. All right, here we go. Let's go do some tax loss harvesting. No, not yet. We're going to come in here and do a little day trading first. And we're going to do that with bubbles. So how's everybody doing this morning? Beautiful day. I've been watching the markets. How many of you saw my last video on Carvana that I did? I just did a little 1-minute video just to show the overlay of the market, and that's of the accumulation distribution model over the top of Carvana. I wanted to talk about that a little bit too, because oftentimes what happens is our distribution stage, if a market is strong, becomes another reaccumulation stage. So I wanted to kind of follow up and talk a little bit about that too. So we got 3 things on the agenda today that we need to cover. Hopefully we get time to cover them all. Let's come in here. First thing we're doing is we're looking at the FinViz heat map, and you can see Microsoft's down, Nvidia's down, Apple's up a little bit. We got just kind of across the board. It looks like the big ones, Google, Meta, Amazon, those guys are all losing, but everybody else is doing pretty good. Walmart's up there, Tesla's up there making a little bit of money. Home Depot doing pretty well. So this is just our little heat map of the markets, just telling you what's up and what's down. Looks like the big 7, the Series 7, the Magnificent 7 are all up. I mean, all down, except for Apple, are all down. So we got all the big red ones are all down. These looks like to me, they look like mostly this is the, I liquidated for those of you who follow along with that part of what I do here, I have my portfolio. I've got rid of my, which one was it? It was this Magnificent 7, but it was the Yield Max version. So Mags, no, not Mags. Maggie or something like that. I can't remember. Anyway, I got rid of it. I don't have it anymore. So I'm going to do some rebalancing, and that's some of the money I'm going to rebalance out. And I'll show you my portfolio, show you my real money portfolio, show you how much money I've got sitting on the sidelines getting ready for taxes and what we're going to do there. And I know it's exciting. Taxes are so exciting. Went over and talked to my tax accountant yesterday, and he's like, you got to get your taxes in for 2024. Deadline's coming. I got like 4 businesses, and we got them all done but one, and then my personal. So we still have Pitt News Magazine to do. How about that, guys? Pitt News Magazine needs to do its taxes, and for 2024, believe it or not. And my personals, haven't done those yet either. All right, it's going to be fun, going to be exciting. All right, first thing we're going to do is we're going to come in here and we're going to go over to Bubbles. All right, so there's Bubbles, and there she is. All right, let's come in here and change Bubbles. We're going to give her some volume in here. We're just going to go off of volume. That's the way I like to do it. This is the S&P 500. Oh, my goodness, look at Intel. Holy smokes, look at Intel go. I was so disappointed in Intel. I had traded a lot of Intel, but look at it go, man. It's taking off and going to the moon. Got to do some Intel business. All right, we got to do a look at a little Intel today. That's Home Depot taking off like a rocket ship. Holy cow, look at that baby go. What are some of these bigger ones? That's Tesla trying to be a big mover today. AMD. Oh, that's a little disappointing. Actually, it's not. We need AMD to pull back. AMD is really flying high, and it needs to have a little bit of a pullback so that we can buy the dip. Palantir. Yeah, I told you guys. I dumped Palantir last week, and everybody was like, why'd you dump Palantir? That's the best stock in the whole wide world. I said, because it can only go up for so long. Look at it go. Look at it flush like a toilet. I said it was going to. I was like, watch out. I got rid of that one too. And that was a hard one to do because I really do like Palantir. Made a lot of money on Palantir, and I hated giving it up. But I knew I didn't know. But I felt that based on the mathematical models that we were in a position that we should not be holding that baby. So I dumped it, and it's flushing like a toilet. Look at it go. That's good though, because for those of you who didn't have any Palantir, let's go look at Palantir. We got Palantir, Intel, AMD, what's this one? And NVIDIA. NVIDIA, I think I took my NVIDIA off too. We better go look because that's going to be an important part of what we're doing here. Okay, we'll pull up my portfolio and see what I got left in there. Right now, I'm looking at it and feeling pretty smart. Land was pretty smart. But I have a little Carvana itch I want to talk to you about. Let's come and look. Okay, this is my real money portfolio. Now, this isn't complete. I told you I'm still working on this spreadsheet. I'm going to give it to you. Anybody who wants it can have it. But to get it, I put hundreds of hours into these spreadsheets, and I just give them away for free. Well, not exactly free. You got to be a subscriber to Pit News Magazine. If you subscribe to Pit News Magazine, then I give you all these spreadsheets I do for free. So it's not really free, but $39 a year is your subscription to Pit News Magazine. That's all you have to have so you can get these spreadsheets. All right. For those of you who are spreadsheet aficionados, some of you may not be spreadsheet aficionados, and you don't have spreadsheets, and you don't like spreadsheets. But for those of us who like spreadsheets, this is the way to track your portfolio. All right, especially these dividend portfolios, because your little brokerage firms who do this stuff, like these guys, right? Track and Trade is a brokerage firm, and you track all of your trades over here. They don't track your dividends. Just like I don't know any brokerage firm that tracks your dividends properly. All right. So if you're a dividend trader, like I am, like I've become, then you have to have some other means of tracking your dividends because they don't track them properly. So that's what I do with a spreadsheet. But a spreadsheet is a difficult product. Not a lot of people like to sit here and do these great, big, nasty spreadsheets. And this is my third iteration, right? Because I've had my old iteration, which looks like, oh, I guess I finally deleted it. Cleaned up my spreadsheet. This is the current iteration. And I got two accounts that I'm working with this program on. So I got the traditional IRA and I've got the individual, and then I've got the new model, which is this one. This is the old one. And I call it the old one, but it's still the current one because it's the only one that's really up to date, or working what I would consider to be properly. Let's bring this up where we can see it a little bit better. Zoom level, zoom. Let's come in here to zoom. Let's see if 75% is a little bit. That's a little better. You can see a little bit better what's going on. So that's my spreadsheet. Now, I stopped updating this one, so I guess it's not really as up to date as I'm kind of giving the impression. This one now has more up to date of what I'm doing than that, but it doesn't have all of my numbers up here yet. Still trying to work out. See this? There's nothing up there. Those are all empty. So I still have to work out what's going on there. But we have Tesla. So I have Tesla, which is actually TSLY. So these are the Yield Max and the Granite Share funds. So the only thing I'm holding right now is Tesla and Tesla. So I got two Teslas, you can see here. I've got BD. I rerouted some of my money. Hold on a second, man, I'm losing my voice already. Let's go here for a second. All right. So Randy's saying, did you dump PLTY? I did, Randy. I dumped it. All right. So I've got, this is all I'm holding right now is Tesla in two funds, and BD. I rerouted some of my money over to BD. Not very much, $26,000, just a little starter in there. Now, what is BD? BETE. BD is actually by ProShares. Okay, so it's the same as BITO. So BITO is out of ProShares. Remember, we got rid of YBIT, which was a Yield Max fund. We did some comparisons, and Ybit went through a stage where it was making a lot more money than BITO. I started off with BITO, and then Ybit surpassed it quite significantly. So I rolled my money into BITO or into Ybit, and now it's back to the other way around. BITO is back to doing better with the NAV, but the same with the dividends. So I rolled it back into BITO. And on that one, I've got $120,000 in BITO right now, and it's kind of being a little sad, so I'm a little disappointed. And then of course I got my Misty, and Misty's being a little sad right now. We're going through a drawdown on Bitcoin, and this is Biddy. And so I told you down here on my Bitcoin, I got $325,000 in Bitcoin, which I feel like I got way too much money in Bitcoin. And I had more. I had like 400,000. I took $100,000 out of the Bitcoin. But that was Bitcoin proper. And I took it out and just put it over here where we could get some dividends. And then total Tesla, I got 200,000. So I'm sitting on a little bit of, I've only got $525,000 in the market right now. And I got about $215,000 of cash on hand in this account. And then if we come over here, I've done the same thing. I've got, how much cash do I have? Does it say? Cash on hand. Oh, that's the individual. Oh, that's still the same one right here. Cash on hand. For this one, oh, I guess I got it all back in. I don't think that's right. This says only $1,500. I don't think that one's right. It's not up to date. See, that's the problem with the spreadsheets. It's so hard to keep them all up to date, especially when I keep making new models. That's why we're coming out with the software program. We've been developing it, I know, for 2 years, but we're really getting close. And we're going to replace these spreadsheets. And it's just going to be a little program. It's all real easy, and all your numbers are right there, and it updates it all for you and everything. You don't have to do all the spreadsheet stuff. So we're still looking forward to that. But right now, we still got to do the spreadsheet. So yes, to answer your question, Randy, I am not in Palantir. Hey, look there. There's old Matt. I haven't seen you around here for a while, Matt. It's great to see you. Glad to have you around. We've changed our program a little bit. Since you've been here, we've focused a lot more. We've been focusing a lot more on these new dividend stocks. So these yield max funds, these ones that have been paying dividends, really high dividends, and we're working them like a business. So the business model structure is how we're thinking about this. So it's glad to have you. Good to see you. Maybe stick around a little bit and you'll learn a little bit more about some of these dividends. We can get you into that, doing that. It's a lot of fun. And making a lot more money doing this than day trading. Not that we don't do the day trading, we still do. And we got to jump over and do that. We got to do a little day trading. That's what we got on the schedule for today. We're going to do a little day trading in the stock market, and then we're going to come back over here. I wanted to bring this up just for a second to show you why some of the thoughts that I'm having over there in the stock market. But you can see what I've got in my portfolio right now. You can see I've got 2 Teslas, BD, BITO, and come on, slide over, and Misty. And then if we go down to the second row, you can see my second row down here. Everything is empty. I don't have anything. I got rid of NVIDIA. I got rid of PLTY. I got rid of Carvana, or actually I didn't have Carvana. I'm thinking of putting 50,000 in Carvana. We're going to go take a look at it. I don't know. That's what I want to talk to you about on the accumulation distribution model. And then on Robinhood, I'm watching Robinhood because, man alive, that thing's been going crazy. But we need a little bit of a pullback on that one. They pay good dividends on this one. And then AMD, we're waiting for that one to pull back too. So those are all empty. Those are all prospective ones that I haven't got any money in. But you can see I made a lot of money in NVIDIA and Palantir. So in Palantir, you can see our revenue. We made $51,000 this year so far in Palantir, and we made $23,000 in dividends in NVIDIA. So that's pretty good. So, but we're out of them now. So let's go pull them up and take a look at them. Let's go over here and see these. So first, we got to go look at Intel. Palantir's flushing. That's good. AMD's flushing. That's good. NVIDIA's flushing. See, we got out of all those. We're smart over here. We know. We don't know. We make good guesses. We're good guessers. We're pretty good guessers. All right. We don't always guess right, but we're usually pretty good guessers. All right. So there's Palantir. Let's go look at it because it's flushing, flushing, flushing. That makes me feel smart, smart, smart because I got out last week in anticipation of the flush. All right. Let's go look at Palantir. There it is. PLTR. There it goes. Why did we think that was going to flush? You guys all know already. Drive 1, drive 2, drive 3. And we had drive 1, drive 2, drive 3. So we come in here. This is our C1 right here, right? This is back here. We kind of combined that one. That's one drive. It kind of did a little flip flop diddle diddly in there, but that's okay. So this was a B1, and then this back here was our A1. So this is how we count our waves, our Elliott wave patterns accumulation distribution model. And that's how we saw that. And then within this one, we had 3 drives. So we ended up, it's classic, man. It's like right straight out of the manual. So C2, and then this was a C3 right here. So we were at the top of a C3. And what happens at the top of a C3? Well, generally speaking, we generally get a flush in the market. So because it was so classic, I was like, we better just play the classic move. And I got out like right in here. I got out clear up here. So I was out, didn't take any losses. And I was feeling kind of like, it's not dropping. And then it did. Whew, and then today broke the blue lights and down she roars. How far is it going to go down, Land? Well, I don't know. Nobody knows how far it's going to go down, right? Look, it's coming down and touching this area of support right here, this line we got drawn in here. If you draw enough lines on your chart, you can eventually hit one and you can say your system works. So draw lots of lines. Just kidding. That's a joke. All right, that's a joke. Don't draw too many lines. Be statistically, mathematically correct about your lines. All right, why are these lines in here? Well, they're just natural trend lines. That's all they are. Just lining up some of these low spots and drawing out into the future. So kind of where some of these areas of support are. And those become important because people watch them, and it's kind of like self-fulfilling prophecy, and people see that and they start buying and using those support and resistance levels. All right. Let me see if I can get out of the way. I'm always in the way. Yeah, I hate this dumb little thing. All right, there we go. So this is Palantir. And we were actually not buying Palantir. But remember, when we trade these yield max funds, we always look at the underlying. And that's what we trade. We trade the underlying, but then we put our money into the dividend fund. And the reason we do that is because the dividend fund has got nothing to do with the movement of the underlying fund. And the underlying fund is where you make your money. They're going to take the money that you give them in the Palantir Yield Max Fund, and they're going to come and trade it for you on your behalf over here. So you really only care about this market. You know, what's happening over there is pretty much irrelevant. All right, it's just a holding. It's a holding tank for your money so that they can use it to trade options over here. All right. So we're out of Palantir, and that was a good move. So how far is it going to come down? Well, to that red line. We got lots of lines. It can come down to any of them. We don't know. That's why we dollar cost average in, dollar cost average out, right? Because we don't know exactly where it's going to come, but we can make some educated guesses. So we're going to come down here with our Fibonacci ruler and we're going to go from top to bottom. And so if this thing comes down, this is the Fibonacci sweet spot right here. Oh, wrong tool. Hate it when I grab the wrong tool. All right, so that comes in, and this is where we'd anticipate this market ending up at. Right, somewhere in this little circle here, out in here. It might take a little longer. But it's not going to come straight down into it. Doesn't usually. I mean, usually, right, we get these little ABC patterns. So we're going to anticipate a little ABC patterns, maybe down in here somewhere. We're going to get a little rally. That blue light's going to flip and come to the other side and start coming down. And usually it goes up, breaks the blue light, and then flushes one more time. And that gives you that little X1SA1, right? X1S. So right in here, we're going to anticipate an X1S A1. And now they use that as a sucker hole. I call it a sucker hole. How many of you are pilots, fly airplanes? If you fly airplanes, you know what a sucker hole is. Sucker hole is when you're out flying your airplane, you're on your way to go somewhere, usually home, because you got get home-itis, and you want to get home, and there's a little blue patch of sky up there ahead of you in that big, huge thunderstorm. And I'm going to go through that. I'm gonna fly my airplane through that little patch of sky, that blue sky, so I can get home. And I'm gonna avoid that big thunderstorm that's all around. I'm gonna get past it. I got get homeitis. And you go through that little hole or you start shooting for it. Before long, it closes in and you look behind you and there ain't no blue sky behind you and you're inside this big cloud and you're dead. All right. You run into a granite cloud, we call them. That's a mountain. All right. So that's a sucker hole. And they suck airplanes into them all the time. And airplanes fly into those sucker holes and they die. So this X1S A1 is what I call a sucker hole. Because what happens is the market comes down, it flushes really hard, like it's doing now. And this is classic. All right. Right straight out of the manual. Comes flushing down like that. And then it catches and it starts to rally once again. It goes, and that's where all the retail traders jump on. Woo! Like flies on, you know what? All right, flies on. I can't say it. I have to go to the, but it's just so graphically good word. Can't say it, or I'll have to go to YouTube confessional. All right, so we're going to try and keep this clean, children friendly. All right, so that's going to come down here. And then all the retail traders jump on like a bunch of ants on candy. How's that? And then it starts to run back up only to flush one more time and take all their money. And that's what they love to do. Big, huge speculators. They love to take all your money on that sucker hole right there. It's called an X1SA1. All right. It's the first exit to the downside and it's the first rally to the upside. That's why we call X1. So it's the first exit to the downside. So if you take a short position here and it starts to rally, that's where you get out, take your profits. That's why it's called X1. And then it's called A1 because it's the first rally to the upside, which in my opinion, in my experience, like 90% of the time that thing fails. All right. No, I have not done any back testing with gamma exposure. So this comes along, and as it comes down, we come up and it rallies back up. It hits that thing and then turns and flushes one more time. And that's when it comes down here to 38.2, 50, 61.8 down in this region here. And this is where we can start to, do some re-entries. All right. This is where we can start getting in. So we can start at 38.2. And if it hits 38.2 right here, the first time, without going back up, I would be really hesitant to buy it. It's got to go up before 38.2 and then come down to 38.2. We got to get a little rally before that. Where's it going to be? We don't know. It'll be in here somewhere. And hopefully it doesn't just come all the way down to 38.2. Because if it does, then you're going to like, oh, crap. Because you want to buy in at 38.2. Sometimes I'll skip 38.2. Depends on how strong the market is. Palantir is a really strong market. So at 38.2, we might want to be buyers. But you kind of want to be buying mostly your first tranche. You can put it in, you can put a little bit in at 38.2. Because sometimes you feel like you might miss it if it takes off and goes the other way. But then we'll buy some more at 50 and we'll buy some more at 61.8. If it goes down further, there's a 78.6 down in here. I don't usually turn it on because it's pretty rare. But we can buy down in here too. But once you get down in here, then you have to start worrying about being in a bear market. So you have to start taking that into consideration. So anyway, we're just looking for this market to pull back. And when it does, I'll load back up again because I had in there, how much did I have in there in the first place? I had in Palantir at one point, how much did I have in there? It says starting. Oh, let's see, capital. I think I had like $75,000 in there at one point. That's a good little, I wanted more actually, because this was really going. So that's what we're looking for on Palantir. All right, let's go back over to Bubbles. And Palantir, AMD. Let's go look at AMD. AMD's another one we had and we dumped. And I think I took it clear out. I took it out. It's not even in my list anymore. I cleaned it out. So if we go back into AMD, not AMD, NVIDIA. If we go back into NVIDIA, we'll add it back in. But right now I'm holding tight on NVIDIA. Let's go look at NVIDIA real quick. We got it in here already right there. So there's NVIDIA. And if we look at that, we're at the 161.8% Fibonacci projection zone. So we got that first run. So we go from A to B on that first run. Turn on, you right click on that tool in Track and Trade, go Fib Projections and display your projections. And it's going to give you the Fibonacci projections. And you can see we're right up here riding along the 161.8. And so that's where I dumped it. Now, the problem is I dumped it a little early. Agreed. I did. I dumped it a little early, but I'm not just looking at one stock in isolation. I also look at other stocks and where they're at in the families. All right. And the other families were at the 3 drive pattern. This one was only at the top of barely got to the top of the 3rd drive, which means it could go farther. Let's label it up here. Let's come in here. And so this is our A1 right here, right? This one right here, this is our B1. And then right here, this is our C1. So if we label that up properly, you can see where, oh, come on, Lan. Why can't you click, 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 delete? Not all notes, just this one. Okay, so I'm right here at the C1. And this is the B1. And this is the A1 right here. I'll make them a little bit more specific. All right, so now what we come in here, this right here is actually just a C2. That's all it is. C2. So does it have some more upside potential? Sure, it does. It's just a C2. So you can go to a C3, right? I mean, Palantir did. Palantir went up to a perfect, beautiful little C3 and had a nice little rally up the top of C3. And of course, it doesn't have to stop at C. It can go D, E, E, F, G, H, I, J, K, L, M, N, O, P, Q, R, S, X, Y, Z. It can just keep on going and going and going. It's just the probabilities get lower and lower and lower and lower once you get up into these numbers. All right. So we just play the probabilities. It's like going to Las Vegas. You sit down at the blackjack table. If you don't know what the probabilities are, you better not play. So you got to understand the probabilities. And that's what these numbers are here. That's why we count them out like that. So we find out what the probabilities are. You've gone to Las Vegas and you've seen those little cards that you can go into the card shop or into the bookstore shop down there and in the casino, and they'll give you these little player cards, and they'll actually let you take these little player cards and put them on your table. They don't let you put a lot of things on the table, but they will let you put those little player cards on the table, and you can see your odds. And then you can look at what the dealer has, you can look at what you have, and you can say, what are the odds that I'm going to beat that dealer? And it's got a little table. You go crossed and down, and oh, there it is, and you can see what your odds are. Well, you need to do the exact same thing when you're trading. Trading is trading the odds. Now, if you're just going to be an investor and you're going to buy and you're going to hold it for 30 years, you don't need to do all this stuff. But if you're going to try and capitalize the exponential nature of the market, which most traders don't, they think they are, but they're not. They're doing linear purchases. They buy it and then they hold it for 30 years. That's not exponential growth. Now, they'll tell you that it is. There's going to be guys out there that'll sit there and say, no, that's exponential growth. Let me show you how you're exponentially growing your stock. Then that's BS. I don't care. I will argue with them all day long that that is not exponential growth. The only way you get exponential growth is if you have more shares. You've got to do something to accumulate more shares. Well, I buy more shares. Yes, you do. You go to work at McDonald's and you get money and you go out and you buy more shares. That's still not exponential growth. If you have to go to McDonald's to get more shares and work at McDonald's, then you ain't getting exponential growth. Exponential growth means that the money that you're making is buying more shares. And so if you buy it and hold it for 30 years, you ain't getting exponential growth. That's why in your 401k, you put in money your whole life, and at the end, you only have $300,000. And you're like, what the hell? I thought I was supposed to be a multi-millionaire from exponential growth. No, you're not. And that's why you're not, because you're not getting exponential growth. You're getting linear growth. All right. You buy it and you hold it for 30 years. And and at the end of 30 years, you still have 10 shares because that's all you bought. Oh, yeah, 10 shares are worth more, but you didn't have exponential growth. The only way you get exponential growth is if you get more shares. If the money you have in the stock market gives you more shares. And if you're not buying and selling, because that's your strategy, flipper, right? If you're a flipper where you're buying and selling, buying and selling, buying and selling, so you can increase your share quantity, then you're not getting exponential growth. So buying and holding is not an exponential growth strategy. That's like going out and buying a house and living in it for 40 years and then saying, well, I got exponential growth. No, you don't. You just got a more expensive house. Exponential growth would have meant that you had 30 houses now. All right. And just because you bought a house and lived in it for 30 years doesn't mean you now have 30 houses. All right. So anytime anybody tells you that just by investing in the stock market and putting your money into a 401k for 30 years is exponential growth and you're going to get exponential growth, you can flip them the bird and say, that's bullshit. You're lying to me. Either you're stupid and you don't know what you're doing, or you're dishonest and you're trying to sell me something. Okay. So we need exponential growth. Now, that's one of the reasons why we like the yield max funds, right? We like the yield max funds because they give us exponential growth. Why do they give us exponential growth? Because they take profits along the way, and they do that for us. So if we're not good at doing it ourselves, if we're not good at coming in here and saying, well, Palantir is going up in value and I'm going to buy it here, and as it goes, I'm going to sell some, buy more, sell some, buy more, sell some, buy more, sell some, buy more, right? So that we can get more shares so we can exponentially grow. And you're like, well, I'm not good at that. Then you can just give it to somebody else and they'll do it for you. Now there's funds you can give your money to. You can go in and say, well, I'm going to give it to, what's a good one that we can say? We're just going to put it in the QQQ, right? QQQ's got big growth, but if you put it into the QQQ, again, it's not exponential growth because they're not buying and selling along the way. They're not accumulating more shares. So you can give your money to somebody else and they can trade it for you because you put it into an exchange traded fund, and they're going to do the same thing. They're just going to take your money and they're going to go buy a bunch of shares of something, and they're just going to hold them for 30 years. Again, you gave your money to somebody else to do the same thing you could have done yourself. So that's what a normal ETF is. So these ETFs, these yield max and yield boost funds, they're brand new. They've only been around for 2 years, right? Now there's been some that have been around longer, JEPI and JEPQ, a couple of them, and there's a couple more that we could mention and go to, who do exponential growth strategies where they have high dividends and they keep buying them and put them back in, right? They do that drip strategy. I'm not real fond of drip because oftentimes the funds that go back in, you're pulling them, you're putting them right back into the same thing you just pulled them out of, which isn't always the best decision, right? Sometimes you want to put them somewhere else or not put them back in. You don't want to be putting money back in at a C3. Doesn't make sense, because if the market flushes, you're just going to give it all away. So you got to be strategic about your reinvestments of dividends. Now, if they're such tiny little puny dividends like you might get with AT&T or something, it's like, why bother? I call them why bothers. That's why I've never bothered with dividends my whole life until now, because dividends usually are so tiny that, you know, the market can move in one day 10 times what your dividend's going to be for 3 months. So it's like, why bother? It's just, oh yeah, thank you very much for my 1 penny apple. You know, oh, you flushed $45 today, but I got my 1 penny. Real happy about that. So that's why, you know, normal dividends, in my opinion, unless you got 30 years to wait, you know, and millions and millions of dollars, they're not going to do you a lot of good. That's why we really like these yield max funds, again, but they're not regular dividends, and you have to keep that take that into consideration. They're not regular dividends. They're actually distributions on options trading. So when you put your money in there, you're not actually getting dividends. You're just, they're trading options, and they're giving you the premium from the options. All right. So why did we get out of Palantir then if we're trying to do that? Well, we got to also trade. We can't just be, you know, you can't just throw your money in there and leave it for 30 years and hope you get rich, rich, rich beyond your wildest dreams. You got to do a little trading here too. So it's not completely hands off, but at least they're taking the profits along the way, and they're giving you the dividends, and you can reinvest them somewhere. And I'd recommend, please do not put them right back into the same thing. If you got drip turned on in your program where you're dripping those things, go turn that off right now. That's the worst thing you can ever do, is drip. In my opinion, that's like commandment number 1 of things not to do, or things to do. All right. Thou shalt not drip. Commandment number 1, don't drip. Okay. So the reason we don't drip is because we want to be scientific, right? We want to be, we want to make our swags scientifically wild ass guess. And the great thing about it is that it's got a lot more variation for error, a bigger area for error. You don't have to be perfect. You just have to be, it's like horseshoes. You can be close and still get points, and that's okay, because you're going to dollar cost average in as the markets come down. You're going to start putting your dividends back in as we get into some buy areas. And if it's not perfect, it doesn't matter. You're going to put a little bit more in, and you put a little bit more in, because they're going to keep giving you a little bit every month or every week, right? Depending on which ones you have. And you can and once you get into these buy zones, you can just keep putting it back in at that point. Now, could you drip it? Well, if it's, technically, you could say yes. You could come in here and you could say, well, if Palantir's down here in the accumulation stage, or down here in the Fibonacci sweet spot, and I know I want to buy it, I'm gonna whatever they give me, I'm gonna put back in. Okay, go ahead and flip your little drip on in your little software program, and it'll drip it for the next 2 or 3 months while it's in there. And then as soon as it starts to rally back out, you can go turn the drip back off. So yes, you can turn drip on for a few, but be strategic about it. Don't just flip it on forever. Be strategic about when you turn it on and turn it off. But really, I just like to go to cash, then you can take that money, and you don't have to just put it back into the same thing you pulled it out of. You can go put it over here, put it over there. That's why you have a portfolio, right? You're not just in one thing. So you can move money around and put it in different places. All right, so that's Palantir. That's my little lecture for the day. Let's come over here, and we're going to go look at, we're going to go look at AMD. Did we look at AMD? AMD. Okay, AMD's in the same spot. Let's come in here and label it up. So here's our A1, here's our B1, and here's our C1. You guys didn't think this worked, did it? Well, you must, or you wouldn't still be here in my class. Because we were watching these things back here, and I was teaching you about these A1, B1, C1 drives. Been teaching it like this on here on YouTube for you guys I've been teaching this strategy for 25, 30 years. So I get a little bit of experience, but I've been showing you guys this, and we were down in this big dip, and the market come flushing down, and I started saying, all right, let's watch for our 3-drive pattern up. And you're like, oh, it'll never happen. But look at this. It's as clean as that, right straight out of the book. How many times do I have to tell you? It's right straight out of the book. You think it doesn't happen? It just happened right in front of your eyes. Right in front of your eyes. You guys been coming to this class for 2 years now. We've been doing this. Some of you have been in here for 2 years with me. I see John's been in here forever. Randy, you've been in here. Albert, you've been in here. Some of you guys been in here for forever, and you see this stuff now happening right in front of your eyes. I taught you this 2 years ago. Said markets make these 3-drive patterns, and then they flush. There they are. Let's label them out. There's AMD right there. It's just as clear as a nose on your face. It happens. It happens a lot. Does it happen every time? No, it's not perfect, but it's these big markets where the big accumulation distribution models are run with these great big brokerage firms. This is how they trade. How do I know? Because I was at the board of trade for 10 years, and they taught me the same stuff. So when I was there, I learned it. What did I do? I went and started my own business, created this software program so that we could track this and we could trade it. And I could sell the software, and you guys could all do it with me. That's how I did it. That's what I did when I went to school. I call going to the board of trade my education, my school. So I went to school for 10 years at the board of trade, and they taught me all this stuff. I come back, started my own business, and created my own software program, and I teach this stuff to people. That's what I learned back there, and that's how we trade. What did the other guys that were in my classes do? Well, they went to Wall Street, and they took the same concepts because that's what they were taught, and they put it into these great big huge mathematical models on Wall Street, and that's how come the system works. It's like self-fulfilling prophecy. We all learned it in the board of trade 25, 30 years ago, and we're still all doing it. All right, that's why it works. Okay, so here you go. We're up here. What's this one right here? That's a D, isn't it? It's a D1 fail. Of course it failed. Okay, so that actually broke the blue light up on top, which not C. It's a D. D1 fail. So we got C1. We went up in here into C. It's a C2 right there, and then there's C3 right there. Just right straight out of the manual. If you guys haven't read the manual, go read the manual. I can't make it any more clear for you. I'm giving it to you for free here. Something that took me 10 years at the board of trade to learn, and then 25 years of experience doing it. And I'm sitting here giving it to you for free. And I get guys all the time, that don't work. That's stupid. Okay, don't do it then. I don't care. Go do something else that works. You tell me what it is. When you find something works better than this, let me know because I want to know. All right, here we go. Draw your little Fibonacci ruler in there. Where do you think it's going to go? Well, we don't know. Probably come right down to here somewhere. And when it gets down close, we're going to start buying in. We're not going to just jump in all in. We don't just slide in because it went into the red dot, red circle. We start easing in, right? Dollar cost average in, and as it goes up, we dollar cost average out. I don't have to give my upside down pyramid lecture right now, do I? No, because we don't have enough time. All right, so there's that one. That's where we're going to expect AMD to go. When it's down in here, we're going to start loading up on AMD. Are we going to buy AMD? No, you can. You can come and buy AMD if you want to, but that's the flipper mentality, right? You're going to come in here and you can buy low and sell high, but we're not going to do that. We're going to come in here and we're going to start accumulating is AMDY or AM? What is the same symbol? I've got it already in my list, getting ready. It's AMDY. So we're going to actually, when this gets down here, we're not going to buy AMD. We're going to buy AMDY. AMDY. And why are we going to buy AMDY? Because AMDY is going to trade for us. They're going to trade AMD for us, right? On our behalf. We're going to give them the money. YieldMax is the managing firm. They're going to take our money and then they're going to trade options with it. They're going to sell covered calls against this. Now, covered calls make money when the market rises because they get a little bit of profit from the rising market, but they cap it, but they get the premium from the option, right? That's what a covered call is. So they trade covered calls and they do it very aggressively. So they're going to trade covered calls for you against AMD if you put your money into AMDY, but we're going to wait. And we don't really, again, this is going to mimic a little bit of what AMD looks like, right? It's getting ready to flush. You could put your Fibonacci ruler in here, but we're not really caring. We don't really care about it. Should come back down. Come on. Circle, circle, circle. It should come down into this region here somewhere, but we're not going to really care about this. We don't pay much attention to this at all. We pay all of our attention to this one here. So because this is the one they're trading with that money. I mean, AMDY, when you put your money in there, you're not trading anything. You're just giving them a basket of money, and then they take it out and go trade options with it on AMD. All right. So then they take that money, the options, when they make the premium, they put it back in here, and then they give a distribution, and then they give it to you. So that's how it works. So you can go over here. Now, this doesn't show you the distributions, but you can come and see the distributions. How much money are the distributions laying? I know we got some new guys. We got Matt in here. I got to tell Matt how this is working, Matt. So you're getting kind of a quick introduction. So we come in here and we go back over to, let's pull up AMDY. And if you look, AMDY, see these little blue dots right down here? This is called FinViz, and this is a chart that shows you their dividends. And so if you click on it, they're going to give you 56 cents for every share you have. That's why it's important to accumulate as many shares as you can. If you only have 10 shares, well, they're going to give you 56 cents for 10 shares for the rest of your life. Well, that's pretty cool. But what if you had 10 shares and then 20 shares and then 30 shares and you took the money they gave you and you bought more shares? And not just of this one. That's the whole point I'm trying to make. You don't just drip it back into the same one. You be strategic and smart about it, and you trade it and you capitalize on it, and you can make a lot more money doing it that way. And we're going to get more shares. So our whole name of the game is to accumulate as many shares as you can, because they pay you the dividends based on the number of shares you have, not how much you paid for them. But we want to pay as little for them as we can, because we still want to make money trading the shares, but we want to get the dividends. All right. And if a market's flushing and going down, well, the dividends will kind of help pay for that. You'll lose money more slowly, a lot more slowly. And I got a really good example of that. I can't show it to you right now because it's in my new software program that we're working to build so we can get rid of the spreadsheets, right? But in there, I got two charts. I got one chart that shows you what would have happened, or what actually did happen. It's not what would have happened. It's actually what did happen to my account, real money, without the dividends. And then it shows you with the dividends. And in a market where, this last big flush we had a couple months ago, everybody lost a lot of money, right? I mean, that was a big flush, and people who were holding on, trying to ride through that whole thing, had to sit through a great big drawdown. Well, I had to sit through a drawdown too. I mean, we all did, but my drawdown was tiny in comparison. And it's funny because the two charts sit right side by side. This is what you would have done without the dividends. This is what you did with the dividends. And one was a big flush and one was just a little kind of a dip. Because the dividends, they soften that blow on the downside. It's like, okay, well, Len, why are you getting out of your Palantir then? Why don't you just stay in there? Well, I could, but I wanted to see if I couldn't play a little bit of buy low, sell high. You don't have to do that. I just, I feel like I got a little bit of an extra skill there. And so I take a little bit extra chance, take my money out, see if I can't, I might miss a dividend, but I'm also catching the drop. So I'm playing the game. All right. I'm playing the game. So the point here is that they're going to give you 56 cents for every share that you have. All right. So if you come in here and do your little math, let's just do the little math real quick for Matt. All right. We're going to come in here. We're going to go $10,000. Let's say we got $10,000 and the shares are 860. So we're going to divide that by 8.6. That's going to mean that we have 1,162 shares. All right. If we put $10,000 AMDY, they're going to give us 1,162 shares. Now, every month, they're going to give us 56 cents or something close to it. It changes, right? It's not the same every month because they're trading options. But they're going to give me 56 cents for every 1,100 for every share I've got. And I got 1,162. So we're going to take that and we're going to go times 0.566 equals. So they're going to give me $658 every month for every $10,000 I got in there. Now, if you do your division on that, that's one hell of a return. That's a lot of money. All right. $658 every month for your every $10,000. And you didn't have to do anything but just let them trade your money for you. Yeah, they want some of it. They want 1%. They're going to take 1% or a little bit over 1%, 1.2% or something. So you have to pay them. They're not going to trade your money for free. So, but if you think you can outperform them, if you think you can trade better than they can, if you think you can go to AMD and trade covered calls better than they can trade covered calls, you should do that. You should go do that yourself. But if you're not very good at covered calls, you might want to just give your money to these guys and let them trade your covered calls for you because they'll do it. And that's how they're averaging right now, $658 on $10,000. That's a lot of money. That's that's more than almost a 70% return annualized. Is that pretty crazy? Like a 70% return. Where are you going to go down to Cash Valley Bank and say, can you put my money in a bank CD and get 70% return? No, you get about 3%. Of course, it's guaranteed. There's no loss. You can't have there's no risk. But for 3% versus 65%, I think I'll take a little risk. What do you think? Good idea? And then we're going to compound, right? Because they're going to give us money, and then we're going to take that money and we're going to start buying other yield max funds that they're trading options with. Okay, and we're going to put our money strategically into the markets. And we're going to let them trade our options for us. And that's a lot of money. And you can take that money, $658, buy more shares, and there's your compounding. Now, you have to make sure that you don't blend those monies. All right. I went to McDonald's and I earned $10,000. Worked all year. Okay. You take your $10,000, you put it in AMD, and then they give you $658. Now, if you go in there and say, okay, now my investment into AMD is $10,658 and blend it all together and then calculate your return. Ooh, bad news. Don't do that. You can't count that $658 as your original investment. You put $10,000 in. You didn't put $10,658. They gave you $658. So don't meld those two together and make that calculation and say that's what my return is, because it's not. Because you're going to now take that $658, you're going to put it back into the market, and they're going to start giving you free money on free money. That's called exponential growth. That's where you get exponential growth. You don't get exponential growth by just sitting on something for 40 years. Again, that's linear growth. So to get your exponential growth, they're going to give you, you're going to take that free money they just give you, $658, you're going to buy more shares. Now, whether you buy more shares in AMD or you go out and buy some more shares in Tesla or buy some more shares in something else, that's the point of having a portfolio, right? You don't just buy the same thing you just took it out of. You can, but more likely you're going to want to be a little bit more strategic about it. Make more money, right? Be smart about it. ABCs. Okay, so then we're going to take that money, and now you have to calculate your profits on the free money they gave you versus the initial investment. Because if you meld those two together, screws up your whole math. All right. So don't do that. You got to keep those two separate numbers, and you calculate your returns separately. All right. Okay. Eventually you're going to have to kind of blend money, but you have to always keep your initial investment separate from all of your other reinvestments, because otherwise you're not counting your compounding. You just keep saying, well, I just keep doing math linearly, mathematical calculation, which just kind of destroys your whole profit potential. It shows you're making a shitty return. Oh crap. Now I have to go to YouTube confessional. Said a bad word. Okay, here we go. Let's go look at another one. Now I think you got that. I think I'm driving the point home, right? Okay, let's come over and look at, where did it go? Here it is. All right, let's go back over and look at oh, I lost it. Let's go back over and look at bubbles. Little Miss Bubbles. We love her. She's a cutie. All right, Palantir, AMD, NVIDIA. Oh, we were looking at NVIDIA, and we're counting NVIDIA up, weren't we? Oh, no, we were looking at AMD. Okay. Oh, we did AMD. Did we do NVIDIA? NVIDIA. We did NVIDIA. All right. That's the same thing. That's where we're at right now. So we're looking for NVIDIA's up here in the top of the C's. We're looking for it to break down. Come back now. Now this, and I got the Fibonacci projections on there. So we're going to take that, delete it, and we're going to redraw it. All right. So we're just going to go from top to bottom, and that gives us our Fibonacci sweet spot. We're going to look for it to come in here. We're going to look for the ABC pattern. Don't go into the sucker hole when it first comes up and looks like it's going to. Doesn't mean it can't. It's an A1. It can. All right. But the next one down here will also be an A1. This will be an X1S A1. This will be an X2S A1. And then you have an X3S A1. X1S A1 is the sucker hole. Don't take that one. It oftentimes will kill you. Doesn't mean it can't. Sometimes you can get through those sucker holes and you can make money on them. Sometimes you can go through those sucker holes and you can get home with your get home-itis and you don't crash your airplane. Sometimes you can go through sucker holes and it's okay. It's just, they're dangerous. All right. So the X1S A1 is a sucker hole. Wait for X2S A1. X2S A1, not quite the bad sucker hole. All right. It's got a much better, higher probability of being successful. And an X3S A1, those are good. We really like those. They have a little bit higher success rate than X2S A1. But both of those have higher than X1S A1. X1S A1, again, it's a sucker hole. Be careful with them. Don't take them. I've lost more money on sucker holes than X1S A1s that I can shake a stick at. All right, so that's where we're at with NVIDIA. What was the next one we were looking at? Okay, we did that one. Oh, there's Apple. We don't care about Apple, though. All right. Do we want to go look at Tesla? We got a lot of money on Tesla, or I do anyway. I'm not here to tell you guys what to do. I'm just telling you what I do, all right? Just telling you what I do. How come Tesla didn't pull up? There we go. PQRST Tesla. All right, it broke out. So this was we could go back here and do a whole story on this one, right? But this was the accumulation stage. We went through the reaccumulation stage a couple times. Where's my little reaccumulation stage? So we went through a couple of those. All right, we got up in here. We went through the distribution stage up in here. We went through the redistribution stage right in here. This thing was like a train on rails. It came down here. We went through the reaccumulation stage right here. And then it started to break out and go up the accumulation stage. Then it went into this thing here. So it wasn't quite as pretty as this one, but it's pretty. It's coming in here with a nice little beautiful triangle wedge formation, and it broke out the top. Now, oftentimes it's not uncommon. We draw a line straight through the middle of as close as you can, just kind of right straight through the dead center of that triangle formation, just like that. All right, see that? That dead center line oftentimes will become support and resistance. So it's not uncommon to see the market fall back down and touch that line as it breaks out. Come up, break down. It broke out, come down, back down, touch that line, right? Dead center, and then take off and go again. All right, so we may see that in Tesla. So don't freak out. It's okay. We got our Tesla. We're going to get our dividends. What have we got on our dividends for Tesla? Now, again, we're not, let me open up a new one so I don't have to do that every time. Let's see, how do we do this? I got to open up another tab. I want to go open a new tab. There we go. And so we're going to come over here to TSLY. TSLY. And TSLY is our dividend version. And you can see right here, it's giving us 30 cents for every share we have. And we have, you can buy a share for $7.83. So that's 30 cents for every $7. That's good return. That's a lot of money. All right. So if you have $10,000 in there, that's going to be what? 30. It's almost a 40% return. And it's been a lot higher. Look back here, 66, 46. Some of these real aggressive ones back here. That was 9 cents. That one, oh, but that had a bonus. That was your bonus. Look, $1.28 per share. Of course, it was way up here at that time, $14. Now it's down here, 30 cents, 38 cents. So you get 30 cents for every share you've got. All right. But if the share is flush like this, that's why I get out sometimes, because right, I'm worried about the shares flushing, and I don't want to. Come on, let go. I don't want to. If the share is flush, well, you get the high dividend up there. See, 71 cents, or up in here. This one, $1.28. See, it's a lot higher, but it's way up here. But then if your shares flush, then they give you the high dividends. It just pays the loss, which is why you lose money more slowly, right? Now we're looking for Tesla to go up, and we'll expect the dividends to go up too. But it's all relative, because the share price is a lot lower, but so is the dividend. It's all relative. So this is what we're looking for here. This is where we're going to put our money into TSLY. Now, of course, there's the Granite Shield one too, but we could go look at that one. It's TSYY. And this is also, now this one trades put options, and it's not going up. It's getting right here, but it trades, and it gives you your dividends every week. So see, that's giving you 25 cents, let's say roughly 25 cents every week, whereas TSLY is giving you 30 cents every month. So this is a lot higher, but your dividends, the difference here is that you don't get any, because a covered call will also get profit on the rise of the market, right? Because you get a little bit of the increase in the market. Whereas in TSYY, selling puts, you get zero upside potential. Absolutely none. There is no upside profit potential on this market at all. The market goes up, doesn't matter. It's straight up put selling, and so you just get the premium. But they give you a little bit higher premium. The share price still the same, $8.48, but they're giving you 25 cents, 22 cents, 20, 22, 22, 23, 25, 25, 24. You see? But anyway, that's the difference between the two. That's why I say put a little in here, put a little in the other one, and watch the two and see which one outperforms. Right now, we can go over to our calculator, right? Let's go over to our calculator. Where's your calculator, Lan? I got lots of calculators. Here's one. Oh, not that one. No. This is our break-even calculator. We've got all kinds of little calculators. Oh, there's the course. You want to learn? There's the one we're looking for. So right now, our calculator, see our little investment calculator, you put $10,000 in there and calculate, it tells you what all these funds are going to do. And right now, TSYY is at the top with 140% yield. That's crazy, right? 140% return on your money. Where are you going to get that? The only way you can get that is if you trade on your own. There's very few funds that can do that. Now, you get some stocks that'll go, you get your 100% club, and we go trade those, right? Remember our 100% club, where we pull those up and look at the 100%ers. But you'd had to been in that thing for a whole year to get that 100%. This one here is returning 140% on average, and you're getting your money as they take profits along the way, right? You get your money every week on TSYY. NVIDIA is number 2 right now at 111%. MRNY, 102. I had an MRNY, but I took it off because I don't think the NAV's any good on it. I thought it was going to turn and go, and then they got really bad news, but then it changed again. And I'm just saying, I don't know. I don't like MRNY. I mean, it's in here. I think we got it pulled up in here. mRNA. See, and it's getting ready to go up again. It's mRNA, but you just can't trust it because they're based all on making money off of the coronavirus vaccine. And nobody wants to take that thing anymore. You want to go put one of those in your arm again? How many of you putting those in your arm right now? You going down there every 4 weeks and putting a new one in? Not a lot of people are. Still are some people. But most aren't doing it anymore. Now, they're sneaking it in. They're putting it into things you don't know. I mean, I was in the doctor's office the other day. Look at this. Is disgusting. I was in the doctor's office the other day. I don't know if I put it in here. I was going to show you. I took a picture of it. I was just in for a physical to get my airplane license, pilot license, right? You have to go in and get a physical. And I was sitting there waiting for the doctor to come into the room. And on the wall was a vaccine sheet for newborn babies, recommendation sheet. And I swear it was a poster this big poster. And there was a, those little square QR codes. So you could look it up and get more information about each one. There must have been close to 30 little squares of all the shots, the vaccine they're giving newborn babies. And of course in there was Corona. So they're giving all these shots to these little babies. Baby pops out of mama and 30 vaccines go into them immediately. Bam. Of course they don't do it all. They do it with like 1 or 2 shots, right? But in there's like 30 vaccines. They had sexual transmitted disease vaccines they were giving that baby. They had everything. You can't believe what they were shooting in those little babies. I'm like, is this little baby going to be sexually active? Why are you giving him sexually transmittable disease vaccines at birth? I mean, give the kid a couple minutes to get up and walk around before you start thinking he's going to go out and have sex with his 1-year-old friend. I don't know. It's a little crazy to me. Call me crazy, but I think that's a little crazy. Why do you be giving sexually transmitted disease vaccines to your newborn child? I don't know. Is that a good thing or a bad thing? I don't know. Don't ask me. Anyway, mRNA, that's the whole point of that little conversation, is that they make all their money on coronavirus. And yeah, doctors, every baby that pops out, they get a squirt of that. And so they're still making money. But not a lot of adults are going in and getting their squirts anymore. So that's why this, let's look back at a longer term chart. Let's go to a weekly. Look at that. See, if we turn on our Heikin-Ashies, it's just flushed to nothing. And at one point I thought they were going to turn around and go because they got some government contracts, right? And they're supposed to be coming out with some other types of mRNA style drugs too for cancer and some other things. But Robert Kennedy doesn't like them. And so he canceled their contracts, and that's when they dumped again. So when he did that, that was right here. So I wrote it up like this, and then he canceled those contracts. I yanked it back off. I was like, oh, that's not good. So I don't know. I don't know what's happening here. The thing is, the mRNY pays such a damn good dividend. Look at this thing. I can say damn now because I already got to go confessional. It pays a see, it flushed though. It's down. It's gone. See, but we come over here and look at the dividend it pays. 102% return. But you're just giving it all up in NAV. So I don't know if the NAV can outperform the dividends can outperform the NAV. I don't know. They're selling options. They're selling puts. This is selling calls against it. So, but if the market doesn't, you can make money with calls on a flat market, or even a slightly falling market. And of course, you make more money if the market will rise. But on a flat market or a slightly falling market, you still make money in this market because they still, on covered calls, they're giving you the premium that they're selling on the covered calls. And if the market will rise, you get the profit up to the covered call. So there's money to be made in all three, ups, sideways, and down. But on the down, once it starts going too fast, it can outperform. It can fall faster than the dividends can cover the loss. So it dampens it. It slows down the loss. You lose money more slowly, but if you're still losing money. So in a down market, you're still losing money. You're just losing money more slowly. So if the market doesn't ever turn around and go back up, but see, in the meantime, you're buying low, so you're buying more shares, right? The market's going down, you buy more shares, buy more shares, buy more shares. As you go down, you're compounding your losses. If it keeps going down, then that's the problem. So the whole idea is eventually it's got to catch and it's got to go back up. And I don't know if mRNA is going to go back up anytime soon. So I'm just not willing to play with it. I was going to give it a shot, and I put, I don't know, not very much in, 20 grand or something, 50 grand. I can't remember what I put in there. It wasn't very much. And anyway, that's how that turned out. So let's go back over here again. How come I can't get my thing to pop up? Oh, here it is. All right, so the next one, see NVYY, that's NVIDIA. And that one's the put option. See the ones with the little asterisk next to it? I could put the little asterisk in there so that you'd know that these are doing put options. These are doing all these, the ones that don't have an asterisk, those are call options. But the ones that have an asterisk, these are put options. All right. So those are put options. All right. So that's what that is. Okay, let's come back over. This is this one here. Okay. I know we got to go look at Intel. We'll get there. We'll get there. NVIDIA, we looked at NVIDIA. Oh, we're going to go look at Tesla. Did we look at Tesla? No. Could go look at Tesla. Or did we look at Tesla? Well, let's go look at it again. Oh, yeah, we already looked at Tesla. Okay, so that's why we're in Tesla. We think it's going to go up. So, and we're getting good returns. We can go back over to our little calculator. How come calculator didn't come up? Calculator. There it is. So Tesla. Now, the thing about Tesla is it's been going flat sideways forever. And so that's brought it way down in the list. Look, it's clear down here. Clear down at the bottom. Tesla is only giving a 12% return right now. So we need Tesla to rise. We need some action in Tesla. We need Tesla to get crazy again. We need lots of volatility. We need the implied volatility on the options to go up. And then Tesla will scoot all the way back up to the top of the list again. It used to be at the top of the list. Now it's clear down here into the low to moderate. So it's not returning a whole lot. Not getting big money on that one. It's just been going sideways. So we're not real pleased with that. But it'll come back. It'll be a good one. I think it's going to go up. I don't know. Elon's got political, and that kind of screwed up his stock for one thing. Everybody hates him now. I mean, the left loved him. He was the darling of the left because he was saving the world with his electric cars. And then he started to back Trump for politics. And then the left started to burn down his, they felt betrayed. So they burned down his car things, and he went in, and then all the right loved him, and they were out buying Teslas. And so he got, went from the left to the right. And then he got in a big fight with Trump, and now all the right hates him. They're like, oh, Elon, you. So now the left and the right hates him. So be careful if you have a business. Try not to get political. Fortunately, the stock market doesn't care what your politics are. So you can have whatever political opinion you want and still trade stocks, and nobody cares. Except for your friends on Facebook hate you anyway. So, okay, where are we at? Well, that's Tesla. Let's go look over here. Let's come back over here and look at, that's that one. That's this one. We got to go look at Intel. Let's go look at Intel just because it shot off like a rocket ship. INTC. Not really interested in Intel except for just straight up trading it. And the reason, because there's no Yield Max, Granite shares, neither one of those guys trade it with options. So they don't trade Intel. So you can't really go in and, if you want to just let those guys trade the options for you, you can't do it. But you can do it yourself. You can come in here and trade some options on it. We can sell some premium. We come in here, we go into options, we come in here, go out to 31 days, we'll come in here, and we'll sell a put, just like that. Boom, just like that right there. We're going to collect $27. All right. That's an 8% return. We'll do 10 of them. 8, 9, 10. Of course, we got to make sure there's enough volume and open interest to do it. Come down here to options chain. Yeah, there's a little bit. Well, maybe which one are we looking at? This one down here. Yeah, that's good. 27 bucks. That's good. Spread's only $3. We could go to one here. Spreads a little, make a little bit more. Spreads a little skinnier by $1. A little more volume on open interest. Okay, we'll do that one. Make $340. 9% return on your money in 34 days. That's good money, right? 9% return. That's what these guys are doing. That's what these guys are doing. They're selling options, collecting premium. This would be a cash secured put. So we come in here now. The problem is that the market's already rising like crazy, and so it's going against your implied volatility state. I mean, you've already kind of, missed your opportunity on this one to sell some premium, but it's already taken off. That's the point. And of course, it's making a big run here, which means it could flush tomorrow. Then your puts. Anyway, this is what they're doing. They're selling puts. So you come in here, and we're going to go in here, and you're going to go like this, and you're going to hit market, and away you go. And you got your put, and you just made 340 bucks, right? Just like that. Boom, that's yours. You get it no matter what. Now, the difference is that if the market comes down here and it closes, this is the carnival game side, we just got our 340 bucks, but if it closes below that red line, then you have to give all your 340 bucks back, and as far down as it goes below the line, you have to also give them back. Dollar sign land, dollar sign. So between here and here, that'd be 380. So you'd have to give your $350 back plus another $386. Oh, that's per, and we got 10. So it'd be $3,086 you'd have to give back. So you can lose money here. What? Trading stocks and options, you can lose money? Surprise. Okay, so that's the name of the game, but that's how you do it. If the market stays above the red line, all it has to do is stay above that red line. Anywhere, it doesn't matter. Anywhere above that red line, if it touches the purple line above the red line, you get to keep your 340 bucks. That's all there is to it. And you don't have to do anything but just sit here and wait. All right, there's no action. You don't have to do anything. You just sit here and wait. That's why when you trade the yield max funds, you put your money in there and then you go fly airplanes or ride motorcycles or go gardening or whatever it is you like to do. Go for walks in the park, go ride your bike, do anything. Because the way you make money is through time decay. You just wait for time to go by. See, and as we get older, right, that's the last thing we want. We got our heels dug in. We're like, I don't want time to go by. This will help time go by a little bit more smoothly for you because you're making money as time goes by. All right. So time decay is what makes you money. It pays you the money over time. So now these guys who are doing like yield max and granite shares, they're not just doing one. Okay, they do what they call laddering. So they're going to sell some down here, and they're going to be more strategic about it. They're not just going to come in here and randomly do it. They're more strategic about it. They do them on regular basis, and they just sell them like this, all down through here. So they got them all down through here. All right, so they're selling call options or selling put options. This is Granite Shares, does the puts. So they're selling them all down in here, and they're making all kinds of, strategic setups. And they're not just all on the same day either. They're laddered not only in time or in price, but they're also laddered in time. And so they're really good at this. That's why I say you can come in here, and if you can beat those guys, then bully for you. You should do it yourself. But they're so strategic and so sophisticated about the way they trade their options that it's going to be really hard for you to beat them. I can't beat them. Sometimes I can. Sometimes I've been able to beat them, but it's pretty rare that I can beat them. All right, they're good. They're good at it, and so that's why they have a fund. That's why they have a big corporate New York, trade on the New York Stock Exchange, because they're good at it. And so the thing is that back in the olden days, like 3 years ago, the selling of options this way was only done by institutions. So every time you go and buy an option, right, you buy a call or you buy a put, who was selling it to you? Somebody had to sell it to you. It was very rare that it was another retail trader. So what was happening was all the institutions, the big banks and hedge funds and all those big guys, they were the ones who were selling you the options. Why were they selling you the options? Because it's like free money to them, right? So then we get smart and wise, and we're like, well, heck, if that's such a good deal, why don't we do it ourselves? You can. There you go. Do it. Do it yourself. You're pointing with my tongue. Do it yourself. you could just come in and do it yourself. You can be the big institutions and you can sell the premium and collect the premium to all the guys who want to buy options. Well, that's what YieldMax and Granite Shares decided they were going to do. They're like, well, why don't we do it for the retail traders? We'll come and open up funds. We'll sell put options like the big institutions have always done. They've always been the ones that got all that premium and got all that money, and it's been so highly profitable for them because 80% of everybody who trades options loses money. Well, who's making the money on the other side? Well, it's the big banks and institutions who are selling you the options. So these guys came in and said, well, let's do that. We'll sell the options. We'll be the option seller. We know how to do it. We're big institutional people. So we're going to open up a fund on Wall Street, and we're going to sell options, and we're going to let the retail traders give us the money to trade the options with. And then the way we make money is they have to pay us. So we get a percentage of all their money. So they give us the money. We don't have to have any money. It's not our money at risk. We're going to trade the retail traders' money. They give us their money, and then we'll trade it for them. And then we get a big chunk of money. And all we're doing is the same thing we were doing, for the last 30 years as the big institutions, making all the money on selling premium to the retail traders who buy premium. They just flipped the script and said, let's let the retail traders fund our option selling. And that's what they do. And they're good at it. Okay. All right. That's that. We'll come in here and, we got to go to Intel. We haven't looked at Intel yet. Lan, you keep saying you're going to go to Intel. Oh, that is Intel. Oh, we bought a whole bunch of options on Intel. Let's go ahead and let's buy the rest of these too. Let's go in here. We'll do 3 of these. We'll do 4 of these. We'll do 3 of these. We'll do 2 of these. All right, place our order. Oh, they're not going to let it do us. Edit. They're not going to let us do it unless we do limit order market. Let's see if they'll market order into those. You gonna let you have it? Nope, they're not gonna let us have all those on a market order. Come on, let me have them, just for fun. Not gonna let me have them. Let's see. 74. We're selling, so we're gonna have to go to 74. Oh, that's a lot of money. 70. Let's go like that. See if they'll let us have them. There we go. Look at that. We got them all fixed in there. Okay, we're gonna make a lot of money. Okay, or not really. $6, $15, $20, $48, and we had to pay a bunch in spread. Anyway, that's the whole concept. So you get the concept, and we're not only doing price laddering, but we're also doing time laddering. So they're all laddered in here, and that's how they give you those premiums. Okay, so that's how it's done. That's the put option. That's the Granite shares. Now, of course, the other side of this is the YieldMax. YieldMax comes in here, and they sell the calls. They come in here and they go, boom, and they sell them in here, right? So they sell all the calls, and they collect the premium on the calls. And they ladder. They ladder time and price. So they got all your options in here. They're selling the. Oh, am I doing calls? Yeah, selling calls. So you've got some upside potential. See, that goes up here. So if the market goes up, they make some money on the rise. You don't do that with the puts. There's no money to be made on the puts. Just strictly straight up premium collection. But these, you get to collect the premium and you get the rise in the price of the market. That's how a covered call works. All the way up to these. And then they just stop making money at those red lines. They stop making money, but you still get the premium. So that's why the YieldMax is kind of a little bit more fun, because you get the upside potential if the market actually rises. If it doesn't, you still get the premium, but the market goes down, then you lose the money on that. But this one here is the same way. It's just, but the difference is too, I'll get to give you one more difference between the Granite shares. The Granite shares don't actually come and trade the options on Intel itself, or well, they don't. Nobody does Intel, but they don't go do like on Tesla. They go do a synthetic version of Tesla. So they'll go do a 2x ETF of Tesla, and that's where they sell their options. Not even actually on Tesla. So they're getting, they're doing options, which is already leveraged, and then they go do it on a leveraged ETF, which is leveraged again. And that's how Granite shares gets this big return using put options, even though they don't get the upside potential, and they can outperform the YieldMax funds. That's how they do it. So should we put this one on just for fun? Market. Nope. They said no way, and they took it off. Cleared the screen. All right. We'll do that another time. That's just a little side note. Just a little educational strategy on how these YieldMax funds and Granite shares work. Okay, that was Intel. Is there anything else we need to go How come I can't get my, there we go. Anything else playing out? Pan W, Pan W, Palo Alto. They rocketed up for some reason today. Palo Alto. Okay, that's the S&P. Let's go look at the NASDAQ, which is not going to be probably a whole lot different. And W, NVIDIA, AMD, Palantir, CSX, that's the train company. They look like they're getting up into the C drive. We'd have to go up and take a look, but that's Tesla again. We got something jumping around. What the heck is jumping around? It's probably Intel. All right, let's go look at the Dow. This is just the Dow. NVIDIA. NVIDIA is flushing. That's good. We need NVIDIA to flush. Okay, don't freak out. We need it to come back down. We need profit takers are going to go back down, and then that gives us the opportunity to buy the dip, right? So if you got a little NVIDIA, realize all these things are way overbought. They're way up there in the top of the third drive. So we're going to expect a little bit of a pullback on some of these, especially all the Mag 7s, right? Magnificent 7s. Those are all way overbought, except for Apple. Apple, Apple. I'm not going to go into that. Go into my Apple rant and rave. Oh, wow. Look at Walmart. Holy cow. We got to go look at Walmart. You guys got any stocks you want me to look at? If you got some of you on your own little private Idaho that you're working on, let me know. And we'll maybe go count and measure them. See where they're at we'll do it together. Here's Walmart. Oh, well, it looks a little bit more dramatic on the other market, on the other chart, didn't it? Well, there's 3 times a charm. Charm 1, charm 2, charm 3. So market came down, it rallied up, and then it did the same thing as Tesla. It went through this kind of a little pattern like that. It broke out. Remember, I told you, it comes down, it breaks out, comes back down, and then takes off again. Now, oftentimes they'll come right back down into the triangle. This was more of didn't quite come down as far as I expected it to. Come back down in the triangle, but it did here. Went up, broke, came back, triangle. But this is the 3 times the charm. So that's a buy signal right there. First green candle to make a new high on the pullback of the rally out of that triangle formation. That's a buy. So if you want to buy Walmart, today's the day. Let's come in here. We could do a number of things in here. We could come in here and we could go, I think Walmart is going to be doing really well, and I'm going to buy a 300, and I'm going to do a clear out here. Let's go into, well, that's not far enough. Let's do 396 days, and we're going to do a call option. That'd cost you $1,200. That's not right. 396 days. That's like over a year. You can buy, no way. $1,200, you can buy a leap on. Wow. Buy that baby right there, $1,200. You could sell covered calls against that thing. Poor man covered calls against that thing for the next, you're doing 3 or 4 or 5 of them. Put in $6,000, 5 of them. You could sell covered calls against that thing for the next year. You'd be rich, rich, rich beyond your wildest dreams. All right, let's come in here and do that. That's very affordable. They're only $1,200 for a leap. Okay, we're going to buy that. And then, of course, now what we're going to do is we're going to come in here, go to 31 days, and we're going to sell a call up here. $83, $100. That's a little conservative. I mean, you come down here and be a little bit more aggressive like this, but, you might as well see if you can't get some growth out of it, right? The difference between how far you think that thing's going to grow. Yeah, like that. That would be good. Then it's your little covered call. And so you're getting an extra $100, but you're going to get $1,000 for every one of your shares if it goes up there. And it's going to stop making money above the red line, but you still get your $100 and you still get your profit up to that red line. So let's go ahead and do that. We'll come in here and we'll hit market order, just see if it'll market into it. It did. All right. There you go. Walmart. There's a nice trade for you. That's a beautiful setup. Just stumbled across that one accidentally. That's a nice one. Okay, so, but that one's not going to give you dividends and all that neat stuff. Well, it is. That's what, if you sell there's your $100 dividend right there, $102 right there. So there's your buy, and then there's your dividend. All right, $102 is your dividend based on the long calls that you have. Now we only did one. Oh, why did we only do one? We got 5. Oops, that was an accident. Come back. Come back. Come back. Come back. Where did it go? There it is. Let's do 4 more of them. All right, let's do 4 more of those. No, that's too good. Too good to pass up. Come in here and do calls. We do buy a call. We're gonna drop that in here right on top of that one. We're gonna do 4 more. 2, 3, 4. Okay, now we're gonna get now we're talking. Now we're talking about some money. Come in here. We'll hit market order. We'll place that. Could not write that call order. Cannot be placed to cover short positions. Order must be placed as a buy. Did I do buy? I thought I did buy. Buy a call. Oh, I don't want to buy it. I want to sell it. That's why. Okay, we're going to sell 4 more of these. 3, 4. Don't make that mistake. Okay, did it fill? Positions. Chart. Walmart. 5. Did it give us? It did. We got all 5. We got 5 longs and 5 shorts. So now there we go. Now we're talking. Let's say $100. That's, but we got 5 of them. So we got $500 on our dividend in the next 30. That's $500 a month. There you go, right there. And we got our long position here, which is $6,400 into Walmart for the long option. There you go, guys. There's your dividend right there, 510. And that's exactly what YieldMax is doing. Okay. YieldMax is doing the same, very similar. Actually, they're not quite doing it quite like this. They got 5. This is what YieldMax. You want me to show you a YieldMax trick? This is just a poor man's covered call. So we're going to come in here. I'm going to do a YieldMax trick. Now YieldMax comes in here, and what they do is they buy the long call, but they also sell the puts. They'll come in here and they'll do this. Watch this neat little trick. They'll come in here, and we're doing 5 of them. So we got to pump that up to 5. See if they'll let us have that. They did. Look at that. What's our out-of-pocket risk? No, darn near nothing. Darn near nothing. Wait a second. Why is our puts so much cost expense? Buy calls, 6,000. Sell puts. Sell calls. Sell. How come they only give us $1,000 for our puts that we sold? Well, that sucks. It's because the market rallied today. You need to put those on at the same time. Oh well, they give you an extra $1,000 towards your $6,000, so they brought down your risk here down to you're only in it at $4,900 is all you're in. So that's how YieldMax does it. They buy the calls and then they also sell the puts to help pay for the calls, so they get that additional boost in money, which lowers their cost of business, which is how they get their leverage. All right, that's a YieldMax setup right there. That's exactly what they do. Okay, and so I've showed you what YieldMax does, and I showed you what Granite Shares does. So that's how they do it. And of course, they layer them. They ladder them, both price and time. So they've always got constant going on new ones, and they've also got coming off new ones all the time, coming off and coming on, coming off and coming on, both price and time. So that's how they do it. But if you want to do it yourself, that's how you do it. All right. Anything else we got in here? Oh, what's this one? Home Depot. You want to go look at Home Depot? We can go look at Home Depot. Anybody got anything you want to look at? Let's go look at Home Depot. How come Home Depot's not coming up? Charts. Home Depot. Ooh, look at that. How are you going to read that one? Is this an A1 or is this the A1? I think this is the A1 right here, because we got higher highs and higher lows. Ooh, that's a kind of an ugly little A1. Okay, we're going to call this A1 right here. That means we're going into the B drive. This is B1 here. That's B2 right there. And that is B3 right there. So there's B1. We're going to just put it on the reds. First green candle, make a new high after little reds, gives you the next one. as long as it's underneath the blue lights. Okay, so the blue lights have to break to get the new A1, B1, C1. That's the breaking of the blue lights. To get the little B2, so we're in the B drive. To get the B2, you have to have a little pullback like this, little what we call a pennant or a flag formation, right? So these little babies come in like that. So get another one here. Get a little pennant formation in there. That's a B2, and then because we're still in the blue light, so that's the B3. And I labeled it B2. Land, confusing people. All right, so that's a B3. So we're going into a B3. Do you want to buy at the top of a B3? Nah, not really. I think I'll wait. I think I'll wait for it to come up, finish the B3, come down, break the blue light, and then we'll go into a C1. All right, so we'll go into the next drive, which will be the top of the drive. So it'll be a C1. That'd be a better place to buy. Not really thrilled about a B3. I would have been thrilled about a B2. That would have been a good place to go in. B1 would have been good too. We'd had to sit through that. B1 didn't grow very much. That's where we get our spider web, right? We come in with our spider web and we go like this. Here, here, and here. Oh, there. So that's your spider web. And we'll get another spider web up here. We don't know where it's going to top out, but wherever it tops out, we'll get another spider web. We'll get a natural trend line. We'll get a mathematically calculated trend line, which will be the blue light. And then we'll get a horizontal breaking above the previous high. So those are your 3 different locations you can get in on the C1. However aggressive you want to be. You want to get in here, you want to get in here, you want to get in here. I'm not real fond of getting in here. Oftentimes I like to be taking some profits off it at the break of the natural above the previous high. But that's what we'll look for on Home Depot. All right, let's go back and look at bubbles one more time. That was the Dow. Let's look at the Russell. The Russell's all the little ones, the small caps, right? We got one big nasty one up in here that jumped like crazy, PLMY, but the volume's not very big. What's that one? Wolfie. Nothing really. Let's get rid of this one because it's kind of screwing things up. PLYM. Okay. We don't have anything really day tradable. Closest thing is this little Iovance, PJan, Wolfie. And there's going to be no options on these. I can almost guarantee you. Let's go look though. IOVA is our best one today. Boy, day traders are going to be sad singing the blues today. What is it? IOVA. IOVA. Well, that's not a bad long-term buy. I mean, it's a nice little, you look at this. Of course, you want to do a little bit of research on it and go take a look. But it dropped all the way back into the fib line, 78.6, all the way back into here. It's at 61.8. It's getting ready to cross the blue light. We'll probably get a little something like this, I would imagine. Get a little rally here. We'll get a little pullback. And maybe, who knows, might get something out of that. I don't think we're going to get any options on it. Oh, there are some. Oh, there's actually not bad. Look at the open interest on that. Let's go a little further. Let's go out to, let's see what let's just start with 120. Oh, I'm pleasantly surprised. That's pretty good. 120. Let's just come in here. 120. Let's just come in here and buy a call. $80. Who knows? It's $80. Let's do 3 of them. $240. 200. Let's do $500. We'll put $500 on it. There's $560 for 7 of them. $480. We'll do $480. We'll do 6 of these things. Right? Who knows? It's $500. You never know. This thing might take off and go to the moon. And if it doesn't, if it goes down, sell a couple covered calls against it. So you don't lose your whole hiney. Reduce the, see if they'll just let us mark it in. Okay. There you go. $500 bet. See if that market over the next 122 days, what's that? 30, 60, 90, 3-4 months. See if that thing won't rise a little bit. How high has it got to go? Well, it's got to go enough to pay for itself, which in this case is $80. So it's got to go up $80. It's got to be above here. That's your break even. So in 100 and something days, 122 days, it's got to be above that blue line. Otherwise, you lose your charts. You lose it all. You lose it all. Quit scaling on me. So there's your carnival game. $500. Anything above that blue line will be profit. Right? Of course, you don't have to wait for it to go to the purple line. If it makes money, if it takes off and goes up here and makes you $500, take it. But anything above that blue line at expiration is your profit. So, and we got 6 of them, right? So that's $131 each, and you got 6 of them, so it'd be $600 up to there. All right, that's a small account trade on Iovance Biothermacric, whatever it is, biotherapeutics. Iovance Biotherapeutics. So you could probably go ask Grok to do a SWOT on that, see what he comes back with, see what he says. He might have some good news for you on that. Maybe they got some biotherapeutics approved, and they're going to make all kinds of money, rich beyond your wildest dreams. All right, there you go. We didn't do day trading on it. We could come down and say, oh, let's come down here. Let's come down to a 2-minute chart. Oh, we kind of bought it on the dip back, didn't we? So it took off this morning, and now it's flushed back down. So that's the day traders. They like to ride that first hour in the morning, and then once they bail out, they take their profits and down it goes. So we missed the opening rally, the opening volley. All right, guys. One more thing, I'll just jump back over to my spreadsheet here just to cap things off and let you know that this is what I've been doing with these funds. And I currently have $215,000 in cash on hand that I'm waiting to put back into some of these funds. I'm waiting for them to flush back down. And you can see right here that I've made so far. Oh, these aren't totaled up. I haven't got my total. Somehow I screwed them up. I was going to show you, but I can show you right here. You can see. How come that one? Oh, because I zeroed them out. That's why these numbers are all referenced out, because I closed them out and didn't adjust. Okay, so that is what that is. I'm going to figure out how to do that. See, in the spreadsheet, it's so hard. Our little calculator, the little program we're creating, that'll all be done for you. So you can see in here, some of I haven't got totals on them. It's going to be no fun to go look at. But I'll show you. On Tesla, I had starting capital $71,000 in January, and I made $3,400 a month. On and then you can see this one. Then I made $3,000, $3,000, $5,000, $7,000, $4,000, $5,000, $4,000. Bitto, I just got Bitto. So, but Bitto and Ybit, I just merged those two together. So I was making, how much did I put into it? I had on Bitto, I had $100,000 in Bitto, and in January I made, and actually that wasn't Bitto, it was Ybit. I just switched back over to Bitto, but it's the same thing. So 8,900, 6,000, 4,000, 4,000, 9,000, 3,000, 4,000, 6,000, and that's on $100,000. That's pretty cool. All right, and then here's Misty. Let's look at Misty. Misty, I had 141,000. And in January, I made 8,700, 7,700, 6,000, 6,000. Made 11,000 in May, 7,000, 7,000, 6,000. That's on 100,000s with Misty. NVIDIA, I had $42,000 in NVIDIA and made 2,800, 3,000, 2,000, 1,900, 4,700, 1,900, 3,000, 1,200. Palantir was a good one. I had starting capital. I started out with 5,200. See, this is your compounding, because I actually had way more than that, right? I started with 5,200, but then I used free money to put back into Palantir. That's the thing about Palantir, is that there's not a penny in Palantir that I went out and worked at McDonald's to put any money in Palantir. All the money that I made in Palantir was free money making free money. This was exponential growth. I didn't put a penny of my own money into Palantir, not one penny. All right, just money I made and I started with 5,200, and then of course I added more, but it didn't come from Palantir. It came from other free money from other markets. I just kept putting all the money into Palantir. All right, so then I come in here. So with a $5,200 initial investment, which was my first drop, but it was not even my money, it was free money. So we started off with 400, then I could put some more in. We got 6,000, 8,000, 12,000, 7,000, 5,000, 9,000 into Palantir. That's how much I was making every month. Now I dumped it. I took it off. Lan, you were making $12,000, $9,000, $5,000 in Palantir. Yeah, but Palantir's dropping right now. So if it's tanking like I think it is, now I'm taking a bet. I'm gambling here. I might lose a $9,000 $9,000 payment of dividend, but I'm worried that PLTR, what's stupid Palantir, PLTR. I'm worried that it's going to flush more than my $9,000. That's the worry. Okay, and it already has, so I'm okay. And that because my NAV probably had some drawdown. Actually, it might not have. I don't know. I'm closing out some of these positions that had drawdowns. This is where the tax benefit comes in. So I got the big payments, but the NAV shows a loss, right? Sometimes your NAV shows a loss. We've been pretty lucky. The markets have been going up, so the NAVs haven't been losing. But if the NAV shows a loss and you made all these dividends, well, you got to pay taxes on the dividends. And so you do tax loss harvesting in September. You take that off. You show the loss here against the dividends. And then when you file your taxes, those two offset each other. You don't have to pay as many taxes on your dividends. So that's a good thing. All right. So that way, that's why September is the worst month in the stock market. And there's an article in Pitt News Magazine about that, where September is the worst month in the stock market. So that's another reason why I was taking some of these off. I'm like, well, we're coming into September, and they're also at the top of a C drive. So when you get those two things coming together, the chances of the market rising is pretty slim, right? Worst month of the year, worst month of the seasonal nature of the market is September. Not always, but it oftentimes will fall. And then we're also at the top of a C drive. So I took those two together, and that's why I felt confident taking the money off. And that gave me the ability to do some tax loss harvesting. So I'm taking some losses on some of my, there wasn't a lot because I was making money, but I took some losses on some of those, realized those losses, not the gains. I realized the gains with the dividends. I realized the losses with the sellout here in September, and that does my tax loss harvesting so I can offset those for my taxes, and I don't have to pay as many taxes. And that's why September is such a bad month, because lots of traders do that. They realize their losses, where they got losses, they realize them in September, because October, November, and December are generally the very best months of the year. That's when markets rocket and take off. Why do they rock and take off? Because everybody did their tax loss harvesting in September. Now, remember, if you tax loss harvest in September, you have to stay out of the market. The market that you took the money out of, you have to stay out of it for 30 days. If you take it out and realize the loss and put it right back in, it's called a wash trade, and then they don't count it as your loss. You don't get to count the loss against your dividends. So you got to stay out for 30 days. So, but you have to stay out. So I can't get back into Palantir for 30 days. That's the rule. But I didn't want to get out of Palantir until I felt like I was in a position where I felt the market was going to fall. And at the top of a C drive, with September coming being the month that everybody does this, I'm a little early, but I was trying to be strategic with the C drive too. So I could have waited until September, which is what most people will do, but I took it early. All right. So I might be able to go in early too, because I only have to be out of Palantir for 30 days to otherwise it's a wash sell. So I want to get that benefit of taking that offset. And then in 30 days, I'll be able to get back into Palantir. But in the meantime, I don't have to go back into Palantir. I can go back into something else. I can go back into, something that's not Palantir. I just can't get back into Palantir. I'm out of Palantir for 30 days. I'm out of NVIDIA for 30 days. I'm out of, what are some of the others I got out of? I got out of, what was that? Magnificent Seven. I mean, YMAGs. I got out of YMAGs and I got to be out of it for 30 days. Okay. So there you go. That's how you do your tax loss harvesting for September. That's how you do your offsets. You got to be out for 30 days. And that's a good lesson. I think we need to take this lesson today. We talked about a lot of stuff, showed you how things work. Put it into the archives. This is a good archive lesson. Go in and clean it up a little bit. But all right, guys, that's all I got for you today. Hopefully you learned something, you had fun, you enjoyed it, and hopefully you're doing a little bit of tax loss harvesting yourselves, being prepared, and offset those profits with your drawdowns, and you don't have to pay as many taxes that way. And then we're going to look forward to dumping all of our money, everything we got, back into the markets for October, November, and December, because those are generally the big rush. Everybody tax loss harvest for the month of September, so they're going to take all their money out in September so they can realize some losses against their profits. And then October, November, December, we're going to get 3 months of massive market runs. All right, but September is going to be bad. Just plan on September this year is going to be a rough ride for anything you've got. If you're going to stay in and ride through it, that's fine. Just realize that's what you're going to be doing. All right. Okay. We will catch you guys. All right. We got to play a little bit. Can't let you go like that. We got to show you a few things here. Hold on.
Okay. This is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right. And then, of course, don't skip Pitt News Magazine. Everybody's got to have Pitt News Magazine.
Look, folks, I was reading this thing, Pitt News, right? Great stuff. I mean, back in Scranton, we had newspapers, but I didn't have, the thing with the facts. Claire Christensen, she gets it. Sharp gal. Reminds me of my Aunt Margie. Could parallel park a Buick with one hand. Subscribe.
All right. We would never use AI to get celebrity endorsements. Never. We never would. All right. This is the last one.
Look, if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally, because you must have something wrong with your brain.
Never use AI to get celebrity endorsements. But we can get this.
Hey, Land Turner here. I got a hot stock market tip for you. Subscribe to Pitt News Magazine. You can thank me later.
There we go. All right, guys. Pick up Pitt News Magazine. That's where you're going to get your spreadsheets. They come along free. I haven't got the new one yet posted. I got the old one out there. You can still use it. And then this one will be coming soon. And I'll try and get this worked out so I can figure out how to get it out to you. But it's got lots of problems, as you can see. All right. We will see you tomorrow afternoon for day trading. All right. 1 o'clock in the afternoon. We're going to do a little day trading in the futures market. Little scalping in the futures market. All right. 1 o'clock Mountain Standard Time. We'll see you then.
All right. That wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.